Alfonso Cajero, A Journey into Finance History. Chapter 63. Historic U.S. Stock Market Crash and Recovery, 2020. Markets experienced swift declines and a rapid recovery amidst the pandemic. In early 2020, the world was buzzing with hope and optimism. Economies were flourishing, the stock market was scaling new heights, and the humdrum of daily life carried on unperturbed. But beneath this veneer of prosperity, a silent storm was brewing. It began as whispers of a mysterious illness in Wuhan, China. Few took notice, fewer still foresaw the impending calamity. As January turned to February, the whispers grew louder. The illness had a name: COVID-19. It spread like wildfire, crossing borders, oceans, and continents. The stock market, initially resilient, began to tremble. Investors, typically rational beings, started to succumb to fear. By late February, the first cracks appeared. Stocks, once deemed invincible, began to falter. The streets of Wall Street, usually a bustling hub of activity, grew somber. Traders, glued to their screens, watched in horror as red numbers dominated the boards. The Dow Jones, Nasdaq, and S&P 500, the triumvirate of American financial might, spiraled downwards. The term correction soon gave way to a more ominous word: crash. March arrived with a ferocity never before seen in modern times. Each day brought a new low, each closing bell a signal of despair. On March 9, 2020, dubbed Black Monday, the market plunged over 7%, the worst day since the financial crisis of 2008. Investors scrambled to liquidate assets, seeking the safety of cash. But the freefall was far from over. March 12th witnessed another bloodbath. Stocks plummeted, and the markets halted trading temporarily to stem the panic. Yet, the panic was unrelenting. The Dow Jones Industrial Average, once soaring above 29,000 points, crashed below 20,000. Trillions of dollars in market value evaporated within weeks. The Federal Reserve and the government intervened, slashing interest rates and introducing massive stimulus packages. But these measures seemed like drops in an ocean of despair. The public, gripped by fear of the virus and economic ruin, hoarded supplies, leaving grocery shelves empty and streets eerily quiet. As the stock market cratered, the human toll mounted. Businesses shuttered, unemployment skyrocketed, and uncertainty reigned supreme. The service industry, particularly travel, hospitality, and entertainment, bore the brunt of the collapse. Airlines grounded fleets, hotels turned off their lights, and Broadway stages went dark. For many, the stock market crash was not just a financial disaster, but a personal one. Retirement savings, college funds, and life savings were decimated. Stories of despair emerged from all corners. John, a small business owner, watched helplessly as his dream crumbled. Emily, a recent retiree, saw her nest egg shrink overnight, her golden years now tinged with anxiety. Yet, amid the gloom, stories of resilience and ingenuity surfaced. People adapted, finding new ways to connect and support each other. The digital world became a lifeline, with virtual gatherings and remote work bridging the isolation. Even as the stock market floundered, a sense of community and shared struggle emerged. In the face of unprecedented crisis, the U.S. government acted with urgency. President Trump signed the CARES Act into law on March 27, 2020. This $2.2 trillion economic stimulus package aimed to provide immediate relief to individuals, businesses, and healthcare providers. The CARES Act included direct payments to Americans, expanded unemployment benefits, and forgivable loans to small businesses through the Paycheck Protection Program, PPP. It was a lifeline for many, offering a semblance of security in turbulent times. But the implementation was not without challenges. Technical glitches, bureaucratic hurdles, and sheer volume of applications caused delays and frustration. The Federal Reserve, led by Jerome Powell, took bold steps. Interest rates were slashed to near zero, and quantitative easing was ramped up. The Fed bought massive amounts of government and corporate bonds, injecting liquidity into the financial system. These actions provided a much-needed backstop, preventing a complete financial meltdown. Despite these efforts, the stock market continued its wild ride. April began with volatility, but signs of stabilization emerged. Investors, cautiously optimistic, started to return to the market. The stimulus measures and the Fed's actions provided a floor, and bargain hunters saw opportunities in the wreckage. By mid-April, the market began its tentative climb. The Dow Jones, which had plunged to 18,213 on March 23rd, started to recover. The Nasdaq, led by tech giants like Amazon, Apple, and Microsoft, showed remarkable resilience. These companies, integral to the new remote work and digital economy, thrived amid the chaos. The recovery was uneven, with certain sectors lagging. Travel and hospitality stocks remained depressed, while tech and healthcare stocks surged. Investors grappled with a mix of hope and caution, aware that the pandemic's trajectory was still uncertain. As spring turned to summer, the stock market's recovery gained momentum. The unprecedented fiscal and monetary measures, coupled with gradual reopening of economies, fueled optimism. By June, the Nasdaq had regained all its losses and was setting new records. However, the summer was not without its challenges. A resurgence of COVID-19 cases in several states threatened to derail the recovery. The market reacted to every piece of news about vaccine developments, treatments, and infection rates. Volatility remained high, but the overall trend was upward. Investors, analysts, and policymakers watched closely as companies adapted to the new normal. Earnings reports reflected the stark divide between sectors. Tech giants reported blockbuster profits, while airlines, hotels, and retailers struggled. The concept of a K-shaped recovery emerged, highlighting the uneven economic impact. The global race for a COVID-19 vaccine was a beacon of hope. Pharmaceutical companies, backed by unprecedented funding and collaboration, worked at breakneck speed. The stock market closely tracked their progress, with every announcement moving the needle. In November 2020, Pfizer and BioNTech announced a breakthrough. Their vaccine was over 90% effective. The market soared on the news, with the Dow Jones crossing 30,000 points for the first time. Moderna and AstraZeneca followed with similar announcements, further buoying investor confidence. The vaccine news heralded a new phase of recovery. Expectations for economic reopening and a return to normalcy grew. The market's focus shifted from immediate crisis response to long-term growth prospects. Companies and consumers began to plan for a post-pandemic world. The 2020 U.S. presidential election added another layer of uncertainty. The contentious campaign between incumbent President Trump and challenger Joe Biden polarized the nation. Investors feared the potential for a disputed election and civil unrest. Despite the tension, the election proceeded relatively smoothly. Joe Biden emerged as the victor, and the market responded positively. The clarity of the result, coupled with the promise of a more predictable policy environment, reassured investors. The prospect of additional fiscal stimulus under the new administration further fueled optimism. The transition of power, while not without its challenges, was largely orderly. The stock market continued its upward trajectory, reflecting the belief that the worst of the crisis was over. But the underlying economic issues, particularly unemployment and business closures, remained significant. One of the most striking aspects of the 2020 market recovery was the tech boom. Companies like Amazon, Apple, Microsoft, and Google saw their stock prices soar. These firms, already dominant before the pandemic, became even more essential in a world reliant on digital solutions. The work-from-home trend accelerated the adoption of cloud computing, e-commerce, and digital communication tools. Zoom, a relatively obscure video conferencing company, became a household name and saw its stock price skyrocket. E-commerce platforms like Shopify thrived as brick-and-mortar stores struggled. Investors poured money into tech stocks, driving valuations to unprecedented levels. The Nasdaq, heavily weighted with tech companies, outperformed other indices. This tech-driven rally highlighted the changing landscape of the economy, where digital and remote solutions became indispensable. Amid the financial turmoil, stories of resilience and innovation abounded. Individuals and businesses adapted in remarkable ways. Restaurants pivoted to delivery and takeout models, fitness instructors held virtual classes, and artists found new audiences online. Communities rallied together, supporting local businesses and helping those in need. Social media became a powerful tool for organizing aid and sharing information. Grassroots movements flourished, reflecting the enduring human spirit in the face of adversity. The crisis also sparked a renewed focus on mental health and well-being. With the isolation and stress of the pandemic, people sought new ways to connect and cope. Mindfulness practices, virtual therapy sessions, and online support groups gained popularity. The emphasis on mental health highlighted the broader impacts of the crisis beyond financial and physical health. By the end of 2020, the stock market had not only recovered but set new records. The Dow Jones and S&P 500 closed the year at all-time highs, a stark contrast to the despair of March. The market's resilience was a testament to the extraordinary measures taken by governments and central banks.